Welcome to the deep dive.
Yeah.
When you think of an airport, your mind probably jumps to, the hum of jet engines, maybe the organized chaos of busy runways, or perhaps just shuffling through security lines.
The usual picture.
Exactly. But what if those bustling hubs were actually far more intricate entities? Imagine them blending, say, the steady reliability of a utility company
Okay.
with the vibrant high-growth potential of a massive shopping mall and even a huge real estate venture all rolled into one.
That's quite a combination. Sounds complex.
It is. And today we're taking a deep dive into Aena S.M.E, S.A., that's A-E-N-A, the giant Spanish company that manages nearly all of Spain's airports, and as we'll find out, quite a bit more.
Right. They're a major player.
A huge one.
Yeah.
We're going to explore how Aena has navigated some immense challenges, think global pandemic-level challenges.
Yeah, that hit everyone hard in this sector.
For sure, and how they've emerged as a powerful global leader in an industry that, well, it literally connects the world.
So our mission for this deep dive is pretty clear. We want to unpack Aena's unique business model. It really is quite different. And understand the powerful forces shaping its present and future, revealing the maybe surprising ways it generates revenue and value. It's all about balancing that stability with explosive growth potential.
And we're drawing insights from a pretty comprehensive investment analysis, right? Something that lays bare the inner working.
Exactly. It gives you a fantastic shortcut to getting really well informed on this infrastructure titan.
So whether you're just curious about how major infrastructure works, or maybe you're looking for those aha moments about global tourism and its economic impact.
We just want to get up to speed quickly on a complex industry.
Yeah, exactly. This deep dive is definitely for you. We're going to help you connect the dots on how global travel, regulation, which is key here, and smart business strategy all come together.
Sounds good. Let's get into it.
Okay, so to really get, we need to start with its very DNA. It's not just an airport operator like you might think. It's often described as a distinct hybrid infrastructure asset. Can you break down what that really means?
Yeah, that's the perfect place to start because understanding this hybrid nature is absolutely key to grasping their resilience and their growth story. It's fascinating. They operate with what you could call a genuine dual-engine business model.
Dual engine, okay.
Think of it like having two distinct but complementary revenue streams working together. Each brings a different kind of strength.
All right, what's the first engine?
So on one side, you have the aeronautical business. This is the regulated core. It's the backbone, providing all those essential services for aircraft and passengers.
Like landing fees, parking for the planes, that sort of thing.
Exactly. Landing, parking, those per-passenger fees for using the terminal, security screening, all the basics you need to run an airport safely and smoothly. The money comes from charges on airlines and passengers for these core services.
And you said it's regulated, like a utility.
Precisely. It behaves very much like a public utility. Revenues are predictable. You have high visibility into future earnings, mainly because the government authorities set or approve these charges.
So that provides stability.
It's the foundational cash flow generator. Provides that stable, reliable income stream, even when markets fluctuate. Just to give you an idea, back in 2019, pre-pandemic.
Yeah, the benchmark year.
Right. This aeronautical business was about 64% of their total revenue. Now, by 2024, it's moderated a bit, maybe around 54%.
Okay, still a majority, though.
Still a majority and still absolutely critical. That shift isn't because it's shrinking, but because the other engine has been growing faster. But this side provides that essential, stable base.
Okay, so that's the steady, predictable utility side.
Yeah.
Then you mentioned a second engine, the commercial business. That sounds like where the action is. High margins, dynamic growth.
That's exactly it. The commercial business is the high-margin growth engine, and critically, it's entirely unregulated. This is where Aena really becomes that sprawling shopping mall you mentioned earlier.
Right, inside the terminals.
Yes. Its core function covers this huge range of activities within the airport terminals. Everything designed to capture passenger spending while ideally making their journey better.
So we're talking duty-free shops.
Duty-free, absolutely. Food and beverage outlets, loads of those. Specialty retail shops, selling souvenirs, electronics, fashion.
Car parking, too, right. That's always a big one.
Huge. Car parking, car rentals, advertising space, digital screens, billboards, and then the premium stuff like VIP lounges.
Okay, so a lot of different streams there.
And the real beauty beauty here is that its performance isn't just tied to passenger numbers, although that helps. It's even more tied to management's skill in optimizing the mix of shops and services.
Getting the right brands in.
Exactly. Enhancing the passenger experience and, crucially, increasing the average spend per passenger. That's the metric they watch closely.
So they're actively trying to get people to spend more while they wait.
Constantly. Curating brands, offering appealing food, creating an environment where you might actually want to spend a bit of time and money before your flight. And it's worked. Its share of total revenue went from about 29% in 2019 to over 30% in 2024.
So that's clearly demonstrating powerful growth.
Absolutely. It shows they're getting better and better at extracting value from each traveler.
So they're not just facilitating travel. They're actively curating this whole consumer ecosystem inside the airport. A very profitable one. And I think there are a couple of other smaller segments, too.
Yes, that's right. Beyond those two main engines, you've got real estate services. This is about leveraging their huge land banks.
The land around the airports.
Exactly. Often very strategically located. They lease out land and buildings for things like logistics hubs, cargo facilities, other businesses that support the airport, or just benefit from being close. It's a long-term play, monetizing those assets.
Makes sense. And the other one, international.
Yes, the international segment. Increasingly important and a key focus for growth. This captures revenue from their airport concessions and operations outside Spain.
So expanding their footprint globally.
Right. It's growing fast and provides really important diversification geographically and in terms of different regulatory environments. Adds another layer of resilience.
So putting it all together, this dual engine structure plus the other bits, what's the big takeaway?
The big takeaway is how this structure lets them mitigate risk incredibly effectively. That stable, regulated aeronautical income, that's your safety net during tough times like the pandemic or a recession. It ensures a baseline profit and cash flow.
Right, the floor.
And then the dynamic, unregulated commercial and international businesses, they offer that significant upside potential. They let AENA capture growth beyond just more planes landing. It's honestly a masterclass in diversification within what looks like a single industry.
Yeah, it really shows an airport can be much more than just runways and gates. It's a multifaceted business. It's incredible how they've engineered such resilience. Now let's pivot to where AENA is just dominant, Spain. They manage almost all of Spain's main airports. Sounds like a natural monopoly. Can you elaborate on that Spanish footprint?
Absolutely. Their position in Spain is unparalleled. It's the bedrock of their success. They manage this vast network, 46 airports and 2 heliports of general interest right across the country.
46 airports, wow.
Yeah. It effectively gives them a natural monopoly over Spain's critical air transport infrastructure, a huge strategic asset for the country. And we're not just talking small regional fields.
No, the big ones too.
Definitely. Major international gateways like Madrid, Barajas, MAD, and Barcelona, El Prat, BCN. These are massive hubs connecting Spain globally, millions of passengers.
And the tourist spots.
Crucially, yes. They run the vital tourist hubs in places like the Balearic Islands, think Mallorca, Ibiza, and the Canary Islands, which are popular year-round. These places are massive drivers of Spain's tourism economy.
So the scale and the importance of these assets gives them a really strong position.
Incredibly strong. They are quite literally the gatekeepers to one of the world's top tourist destinations.
Okay, that makes sense. But with that kind of dominance, there must be strong regulation involved. This is where it gets really interesting. How does the Spanish government regulate this giant? Tell us about this DORA framework. It sounds absolutely crucial.
It is. The Airport Regulation Document, or DORA, is the absolute cornerstone of their domestic business, and you could argue a major competitive advantage. It's a 5-year national framework set by law.
5 years. That provides a lot of stability.
Huge stability and predictability, which is vital for planning massive long-term infrastructure investments. It insulates them from short-term market swings. The current one, DORA 2, runs 2022 to 2026. DORA 3 is already lined up for 2027 to 2031.
Okay, so how does it actually work? What does it regulate?
The key mechanism is something called the maximum annual revenue per passenger. The Spanish acronym is IMAJ. Think of it as a cap.
A cap on how much they can earn from airlines per passenger.
Exactly. On the aeronautical side, for 2024, for instance, that IMAJ was set at 10.35 per passenger. Now, here's the interesting part.
Go on.
While this cap limits their pricing power on the regulated side, it has this paradoxical effect. It basically forces AENA's management to really go after growth and efficiency in the unregulated commercial activities.
Ah, So, because they can't just hike landing fees indefinitely.
Right. They have to get smarter about shops, restaurants, car parks, everything else to drive shareholder value. So what looks like a constraint actually becomes this powerful driver for innovation on the commercial side.
That's a fascinating twist. Does DORA also control how much they invest? Or just the tariffs?
Oh yes, it controls investment too. DORA sets a ceiling on their annual regulated investments. For DORA 2, it's $450 million a year.
Okay, so disciplined spending.
Exactly. It prevents overinvestment that might lead to demands for much higher tariffs later. But looking ahead, the next period, DORA 3rd, starting in 2027, that's expected to bring a much bigger investment program.
Why bigger?
Mainly for major capacity expansions, especially at Madrid and Barcelona. They're hitting limits during peak times. These investments grow AENA's regulated asset base, the RRB.
The value of the assets they earn a return on.
Precisely. A bigger RRB means a foundation for higher future aeronautical earnings under the DORA rules. It's a long-term play to build future regulated income.
Got it. Now, you mentioned government involvement through regulation. What about direct ownership? Doesn't the Spanish state own a big chunk?
Yes, that's a really important point. Spain's public air navigation entity, AENA, holds a 51% majority share in AENA.
51%. So majority control.
Right. Which has pros and cons. On one hand, it provides stability and usually aligns AENA with national interests, tourism, economic development, keeping the country connected.
But the potential downside?
Well, it naturally introduces political risk. Government objectives, maybe prioritizing jobs or keeping airlines happy, could influence strategic decisions or tariff setting, potentially over purely commercial logic. We've seen intense lobbying, especially from low-cost airlines like Ryanair, pushing hard for lower charges.
Okay, so a constant push and pull there between commercial goals and political pressures.
Exactly. It's a balancing act they constantly have to manage.
So a strong government link, but also potential headwinds. Let's talk about the market itself. How much does AENA rely on Spain's tourism industry? Because Spain is just a behemoth in global tourism.
It absolutely is, and this gives AENA this incredible structural tailwind. Spain's tourism sector is a global superpower, and AENA's domestic business is completely tied to its health. In 2024 alone, tourism added, $248.7 billion to Spain's economy.
Wow, that's huge. What percentage of GDP is that?
An amazing 15.6% of national GDP. It represents millions of jobs, a huge chunk of the economy, and the outlook is still strong. The World Travel and Tourism Council expects it to top $260 billion in 2025.
So, continued momentum.
Definitely. And international arrivals are the absolute lifeblood of this. That's what drives AENA's traffic.
Where are people coming from mainly?
The UK is still the biggest source market, about 20% of arrivals. Then France, around 14%, Germany, 13%. These are big established markets. And projections suggest total international arrivals could hit 98.1 million in 2025.
Which would beat pre-pandemic levels.
Comfortably. So this sustained growing demand for travel to Spain provides this incredibly solid foundation for AENA's passenger numbers and, crucially, for that high-margin commercial revenue growth.
That's a massive built-in advantage. And related to that, I see low-cost carriers, LCCs play a huge role. How does that relationship work? Is it a strategic advantage for AENA?
It's absolutely a defining feature and a key advantage, especially looking at their post-pandemic recovery. LCCs think Ryanair, Vueling, EasyJet, they dominate AENA's Spanish airports. They have a collective market share of around 62%.
62%? That's enormous.
It is, and this heavy reliance on LCCs has proved really beneficial. Their model is all about high-volume, efficient, point-to-point leisure travel.
Which fits perfectly with Spain's tourism profile.
Perfectly. LCC traffic is also generally more resilient during economic downturns. Budget-conscious travelers still fly.
Yeah.
And crucially, LCCs recovered much faster after the pandemic than the legacy carriers, who rely more on business travel and long-haul, which took longer to bounce back.
So it's a symbiotic relationship.
Very much so. LCCs bring huge passenger volumes, driving AENA's traffic and especially their commercial revenues. In return, AENA provides the efficient infrastructure LCCs need for their quick turnarounds, which is critical for their low-cost model.
So they need each other.
Exactly. This partnership has been a core reason why AENA outperformed many peers who are more reliant on slower recovering long-haul or business travel. It maximizes volume and revenue for both.
Okay, so AENA clearly operates from a position of strength market dominance, tourism tailwinds, that LCC relationship. But financially, it sounds like it's been quite the ride, especially with COVID. Let's set the scene first. What did things look like pre-pandemic, say, in 2019?
Yeah, 2019 is the crucial benchmark. It shows Aena in really robust health. Total revenues were 4.50 billion. That was driven by massive passenger traffic, 275.2 million just in their Spanish network.
Wow. And profitability.
Outstanding. EBITDA, that key measure of operational profit, hit 2.77 billion. That gave them a really strong EBITDA margin of 61.4%. Super efficient.
And the bottom line, net profit.
A solid 1.44 billion. Their balance sheet was healthy too. Net debt to EBITDA was comfortable, around 2.3 times. So yeah, 2019 showed a well-managed, highly profitable company, really well-positioned.
Right, a company at its peak, which makes the next part even more stark. How did a business so tied to travel handle something like COVID-19? The numbers must have just collapsed.
Oh, they did. It was swift, profound, an existential challenge, really. In 2020, as the world locked down, passenger traffic just plummeted. Total revenue got cut almost in half year over year, down to 2.52 billion.
Half. Ouch.
Yeah. And they recorded a significant net loss for the year, a huge shock compared to their usual profitability. It was just a period of intense uncertainty.
So how did they survive? What were the tactics?
Management acted really decisively to preserve cash. One of the biggest moves was suspending the dividend. They didn't pay one for fiscal years 2019, 2020, or 2021.
Tough for shareholders, but necessary.
Absolutely critical to keep cash in the business when revenue basically stopped. They also launched aggressive cost-cutting everywhere, saving over $280 million in 2020 alone, cutting operating expenses, halting non-essential investments, just battening down the hatches.
Did they need to borrow more?
They did. They proactively secured extra credit facilities to bolster liquidity, just as a safety net. 2021 was still tough, but revenue started to creep back up a bit, to 2.69 billion as some travel resumed. It really showed effective crisis management.
A real testament to making hard choices. But then came the recovery, and it sounds like it wasn't just a recovery, they actually hit new highs. Tell us about that comeback from 2022 onwards.
The turnaround was pretty remarkable. As soon as restrictions lifted, all that pent-up demand for travel just exploded, and Aena was perfectly placed. In 2022, they swung back to strong profitability, 901.5 million net profit.
And the dividend came back.
Yes. Importantly, they reinstated it at 4.75 per share. That signaled real confidence in the rebound.
And 2023.
The momentum just built. They actually surpassed their pre-pandemic 2019 EBITDA levels a full year ahead of their own strategic player. Really impressive. Full year 2023 net profit hit 1.63 billion.
So better than 2019 already.
Exactly. Exceeded the 2019 benchmark. And then 2024, that was a new historic peak.
Correct.
Total group passenger traffic soared to 369.5 million. Unprecedented volume.
And the financials followed.
Absolutely record-breaking. Total revenue surged to 5.83 billion. EBITDA climbed to 3.51 billion, keeping that strong margin at 60.2%. And net profit hit an all-time high of 1.93 billion.
Wow. So not just recovered, but fundamentally stronger. What about their debt levels after taking on more during the crisis?
They managed that down really effectively, too. Their key leverage ratio, net debt to EBITDA, improved incredibly quickly. It went from 3.0 times at the end of 2022 down to a very healthy 1.60 times by Q3 2024.
That's fast deleveraging.
Shows really strong cash flow generation. They're back to a very solid financial footing, lots of flexibility. And the credit rating agencies noticed. Moody's gave them A3 with a positive outlook. Fitch upgraded them to A stable in 2024. Big votes of confidence.
So they didn't just survive, they absolutely thrived, hitting new financial peaks. What does all this mean for investors and their future plans? That commitment to dividends really seems key.
It absolutely is. Aena has this clear capital allocation framework. It prioritizes balancing shareholder returns with strategic investments for growth. And that commitment to shareholders is a cornerstone.
The 80% payout policy.
Exactly. A formal policy to distribute 80% of annual net profit as a dividend. That high payout makes Aena one of the most attractive dividend stocks in the European infrastructure space. Really appeals to income investors.
And the dividend growth reflects the recovery.
Hugely. After the suspension, it came back for 2022 and has grown robustly since. For the record 2024 year, they proposed 9.76 per share. That's a 27.4% increase year over year and the highest dividend ever in their history.
That signals strong confidence for management.
Definitely. So they balance this high payout with keeping enough cash for growth. The main growth investments are things like their international moves, Brazil, for example, and funding that big domestic expansion under the DORA framework we talked about.
And they also did a stock split recently.
Yes, approved for 2025, a 10-for-1 split. The idea is to reduce the high share price, make it easier to trade, improve liquidity, and make the stock more accessible, especially for retail investors. Very shareholder-friendly move.
That paints a really clear financial picture. So looking ahead now, beyond just recovery, how are they planning to fuel future growth? It seems like maximizing commercial revenue is a big one, plus international expansion and leaning into tech and efficiency.
That's right. Their growth strategy is multi-pronged, pretty ambitious. They want to squeeze maximum value from existing assets while expanding into new high-potential markets. And yes, the biggest organic growth opportunity is definitely in those unregulated commercial and real estate businesses.
Right, because they're not capped by DORA.
Exactly. The strategy is laser-focused on increasing commercial revenue per passenger. That key metric of how well they're monetizing each traveler. It grew by a healthy 4.6% in 2024, reaching 6.1 euros per passenger. So the efforts are working.
How are they driving that growth specifically?
Several ways. They're systematically renewing their retail and food and beverage contracts across the network. This lets them bring in new, appealing brands, improve the passenger experience, and crucially, lock in significantly higher minimum annual guarantees, the MAGs.
The minimum rent the shops have to pay.
Yes, and the increases are significant. For example, recent F&B contracts signed in 2024 secured MAGs for 2025 that are 150% higher than 2023 levels for the exact same spaces.
150% higher. Wow.
Yeah. And specialty shops, similar story. MAGs, 145% higher. So this active management locks in predictable revenue growth for years, almost regardless of small dips in passenger spending.
So not just waiting for more passengers, but getting more from the ones they have. What about premium services in those airport cities you mentioned?
Absolutely. They're successfully tapping into the demand for premium experiences. Things like VIP services lounges, fast-track security revenues there surged 31.3% in 2024. Shows they're capturing spending across the whole spectrum.
And the airport cities. That sounds like a huge long-term play.
It really is. Real estate development or airport cities, they're leveraging their massive, valuable land banks around major airports to create totally new, multi-decade revenue streams.
Turning that land into
Integrated economic hubs. Developing logistics parks for cargo, new cargo facilities themselves, hotels, even office buildings. Imagine a whole ecosystem built around the airport.
So not just a terminal, but a whole business district.
Exactly. They hit a big milestone recently, awarding the first 32 hectares for logistics development at Madrid Barajas. That's a 170 million project, just the start. And there are ambitious plans for Barcelona, Malaga, Valencia, Seville, too. It's a massive long-term opportunity.
Huge potential there. Now, beyond Spain, what about global expansion? What are the targets and where are they focusing?
Yeah, complementing the mature Spanish market, they have this deliberate strategic international expansion. The goal is to diversify revenue and get into higher growth regions. They've set a non-binding target for international activities to contribute 15% of consolidated EBITDA by 2026.
Up from what level currently?
Up from about 6.7% in 2023, so significant jump. They're focusing on markets where they can apply their expertise and get real scale.
Like Brazil. I know it's been a big move.
Brazil is the prime example. They acquired 2 large blocks of airports, making them the leading private operator there now. It's a key emerging market, huge long-term traffic growth potential.
Which airports do they have there?
17 airports now, including the really key domestic hub, São Paulo Congonhas. Developing these assets is core to their long-term growth, and it's already paying off. The second block they integrated contributed nearly 200 million in revenue and over 100 million in EBITDA in 2024 alone.
So immediate impact. What about other markets? The UK?
Yes, they have a strategic foothold in the very competitive London market through their 51% controlling stake in London Luton Airport.
A major LCC base.
Exactly. Vital gateway to the UK, especially for European leisure travel, and a huge future catalyst just got approved. Regulatory permission to expand Luton's capacity from 19 million passengers a year to 32 million.
Wow, that's a massive expansion.
Huge. It will drive substantial long-term value and let them capitalize on the demand for London travel. But it's important to say, this international strategy does mean taking on more risk. Well, markets like Brazil offer higher growth, but also more exposure to things like currency swings, political instability, different regulatory systems. It's more complex than operating at home. Success depends on executing big projects well and navigating those local complexities.
Right, calculated risk for potentially higher rewards.
Yeah.
Finally, on the growth front, how are technology and sustainability playing a role? These sound like the silent drivers.
They really are. Silent, but incredibly powerful for long-term value. AENA is investing heavily in tech and innovation to boost efficiency, make the passenger journey smoother, and hit their ambitious sustainability targets.
What kind of tech are we talking about?
On the digitalization and automation front, lots of things. Biometric tech for seamless processing, using your face to get through security and board, streamlines things, cuts queues, improves satisfaction, enhances security.
Less hassle for passengers.
Hopefully. They're also automating internal processes, baggage handling, admin tasks to become more agile and cut operational costs over time.
And sustainability. They seem quite ambitious there.
Very. For sustainability and energy efficiency, they've actually accelerated their net zero carbon goal to 2030. That's really ambitious for an airport operator.
How are they planning to achieve that?
A key part is a massive investment in solar power, building huge photovoltaic farms at their airports to generate their own electricity.
So decarbonization and cost saving.
Exactly. Reduces reliance on fossil fuels and acts as a long-term hedge against volatile energy prices, which are a huge cost for airports. They're also using smart AI systems, like one called Respira, to dynamically manage heating, ventilation, air conditioning.
Optimizing energy use in the terminals.
Precisely, based on real-time data, expecting significant energy savings plus better air quality. These investments pay off environmentally and financially.
It's clear AENA has built a really robust, forward-thinking business. But, no company is without risks, especially ones so tied into global travel and national infrastructure. Let's talk about those headwinds. What are the main operational and macroeconomic risks they face?
You're absolutely right. It's not all smooth flying. Understanding the risks is crucial. Operationally and macroeconomically, the biggest one is probably their dependency on tourism and economic cycles.
Makes sense. Their core business relies on people traveling.
Exactly. Passenger traffic is highly correlated with the economic health of Spain and its key European markets, the UK, Germany, France. A major recession, another health crisis, a big geopolitical event curtailing travel that would hit their revenues and profits directly. It's fundamental.
What about costs? Inflation must be a concern.
Constant pressure from cost inflation. Energy prices, even though they're hedging with solar, are still a big variable. Labor costs, too, potential for wage inflation, operational disruptions from strikes.
Like the baggage handler disputes recently.
Exactly. Even if they're not direct AENA employees, those things impact service and potentially AENA's reputation. And then there's rail competition.
The high-speed trains in Spain. AVE.
Right. On domestic routes, especially Madrid-Barcelona, the expanding AVE network is a growing competitor. Environmental policies often encourage that shift, too. It could definitely erode some domestic air traffic over time.
Okay, so competition from the ground, rising costs. What about regulatory and political risks? That DORA framework sounds stable, but are there risks there? Or from government influence?
The DORA tariff setting is the big one going forward. Those negotiations for DORA 3rd, 2027-2031 are critical. DORA faces intense, often public, pressure from airlines, especially LCCs like Ryanair, pushing hard for lower charges.
Ryanair threatening to cut capacity if charges go up.
We've seen those headlines.
Yeah.
If the regulator approves tariffs much lower than AENA wants, it hits their ability to fund investments and compresses future regulated earnings. It's that constant balancing act.
And the government ownership, the 51% stake.
That brings government influence and political risk. Government priorities, jobs, regional development, airline relations could potentially override purely commercial decisions. It could affect strategy, dividends, even management. And then there's the threat of aviation taxation.
More taxes on flying.
There's a big push across Europe for environmental taxes on aviation. Spain's part of a coalition supporting this. Significant new taxes could make flying more expensive, dampen demand, and hit AENA's passenger numbers.
Okay, external pressures from all sides. What about financial risks? Debt. And the risks in executing those big international plans.
Financially, AENA's business needs a lot of capital. That DORA 3rd investment cycle will require significant financing. If interest rates stay high, the cost of that debt goes up, hitting profits and cash flow. Managing that debt carefully is key.
And the international execution. Brazil, Luton expansion.
Big international execution risk there. Potential for construction delays, cost overruns, navigating unfamiliar regulations, political risks in places like Brazil. It's complex. Successfully delivering on these projects is crucial to validating their global growth strategy.
Anything else specific? Brexit related, perhaps?
Yes, potentially. Post-Brexit travel friction. The UK is their biggest single international market. The new EU Entry-Exit System, EES, requiring biometric checks for UK travelers.
Fingerprints, facial scans.
Right. That could create significant delays and friction, especially when it first rolls out from late 2025. Any major disruption to the UK-Spain travel experience could impact demand on those key routes.
Definitely a lot of moving parts to watch. So given all these risks and the context, what are the key valuation insights? Why might AENA still be seen as a premium investment compared to its peers?
That's a great question because they often do trade at a premium, and there are good reasons. First, they are the undisputed global leader by market cap. Roughly $45 billion, way bigger than peers like ADP in France or Fraport in Germany.
Does size matter here?
It brings advantages. Access to capital, deep operational expertise they can use globally, strong negotiating power with airlines and tenants. Second, their superior profitability is outstanding.
That's 60% EBITDA margin.
Exactly, 60.2% in 2024. It's industry-leading, way higher than Fairport's 27% or ADP's 33%, shows incredible efficiency and the value of that commercial business.
What else? Balance sheet, dividends.
Third, financial health. Stronger balance sheet, lower debt relative to earnings than many peers, gives them flexibility. And finally, dividend attractiveness. That clear 80% payout policy is a big draw.
Providing a solid yield.
Yeah, depending on the share price, often between 3.5% and 4.5% based on the 2024 dividend. Very competitive, not just against airports, but against utilities and infrastructure stocks generally. Provides income and some valuation support.
Okay, so for listeners tracking AENA, what are the absolute key metrics to watch? And what potential catalysts, positive or negative, could really move the needle?
Definitely monitor their monthly traffic statistics. Look at the breakdown domestic, EU, non-EU, international, tells you where the strength is. In the quarterly earnings, dig deeper than the headlines. Focus on commercial revenue per passenger growth versus aeronautical revenue per passenger growth. That's key to their thesis.
And margins, regulations.
Keep an eye on the EBITDA margin evolution for cost pressures or efficiency gains, and absolutely any news or regulatory filings on Door 3, that's critical for the future.
And catalysts, what could boost them or hurt them?
Positive catalysts, stronger than expected traffic, really lucrative new commercial deals with high MAG uplifts, progress on those airport city real estate ventures, a favorable Dora 3 outcome, or faster than expected profits from Brazil or the Luton expansion.
And on the flip side, the negative ones.
Negative catalysts, a sharp economic slowdown hitting travel, unfavorable regulatory decisions, low tariffs, restrictive Dora 3, major operational disruptions like prolonged strikes, or significant new aviation taxes that really bite into demand. Those are the main things to watch out for. Hashtag outro.
What an incredible deep dive. AENA is clearly a unique player, leveraging that quasi-monopoly in Spain's huge tourism sector, balancing the regulated stability with that high-margin commercial side, and expanding globally.
Yeah, they haven't just recovered powerfully from the pandemic, they've set new records for profit and shareholder returns, all while investing heavily in sustainability and digital tech for the future.
This really shows that airports, especially managed like AENA, are so much more than just transit points. They're evolving commercial ecosystems, almost mini-cities, and critical economic engines.
Absolutely. Deeply tied into national and global trends. And as travel keeps adapting, regulations shift, technology advances, it raises a fascinating question.
Which is?
What does it truly take to build and sustain one of these modern airport cities? How do you cater to changing passenger needs, withstand global shocks, and navigate that tricky balance?
Between private enterprise, public interest, and a sustainable future.
Exactly. It's a complex question and one that continues to fly high on the horizon.